Let's delve into what drove the market on the day. Mia Kruger, Portfolio Manager at Kruger International, joining us. Thanks for your time, Mia. Starting with BHP Billiton, if you look at the results today, if you look at the share price, down 4%, and of course a change in management, it seems it's shaken the market a bit.
Yes, no, we saw that negative movement today for Billiton, and the fact is that we knew that this was coming. It's nothing new. We've known that commodity prices have been under pressure, and all these big mining companies are only price takers of these commodity prices. So there's absolutely nothing they can do about it. If you look at the impairments, the one-time impairments that they've made, one of the biggest ones was the fact that they've actually made a very big impairment for their Wolseley and nickel mine, which is both aluminium and nickel, where they've said that they see that the Australian dollar has been very strong, and they think that's going to be strong going forward, and they're also expecting weaker commodity prices from those two commodities. So they may, you know, they've been very realistic regarding that, and if you take that out of the earnings, you know, then you'll see that it's actually down slightly less, still a lot, but only 43%. So it's nothing worrisome for me, because I know that Billiton has done what they've said they will be doing, and they've performed better than most of the other big miners.
Just looking at the sensitivity of the company, they can do all they say they're going to do, but they can't control prices of commodities. I mean, if you just look at their company, a $1 a ton move in iron ore price equates to around $110 million impact on the company. A $1 move in the price of the barrel oil amounts to $45 million change to the company, and they've also got quite sensitivity there to the Australian dollar, US dollar. So all those factors are out of their control. I mean, does this kind of reduce your appetite to invest in companies like this?
Well, I would say that we actually had a large appetite for a company like Billiton while it was at very low prices during last year. I think the fact that the outlook for economies with very uncertain growth, especially looking to the east and to the States, was there, and that definitely influenced the commodity prices to the negative side. So, but what we have seen is that we've seen the east in the likes of China, Indonesia, all those countries coming out with stronger growth than people initially expected, and stronger demand for these commodities. So that will definitely underpin these prices. We've also seen that, and we've seen these prices coming in a little bit higher. So going forward, probably for the next 6 months and then forward again, these companies will get that benefit from commodity prices going up. But there's nothing that you can do about these companies being quite price sensitive, and also you know, so many different areas in a company with a rich portfolio of diverse commodities like Billiton. But that is actually where the benefit lies, in the fact that they are so diverse and that they've got this big portfolio of commodities that you really can't replicate again.
Let's look at the new CEO, Andrew Mackenzie. He worked at Rio Tinto and he worked at British Petroleum, BP.
Yes.
That's an interesting kind of career that he's had, particularly in light of the fact that BHP Billiton wants to move more into energy. Do you think this signals something? Well,
they have moved more into energy, and that's what they've been telling us for the past couple of years. So they've done what they said once again, and they've actually appointed him, like you mentioned, with a very rich experience in that field. He's got more than 30 years of experience in this industry, and he's worked very closely with Marius Kloppers. I think he will be a very good and suited follower for Kloppers, who's done an exceptional job. And there's unfortunately been quite a bit of negative news saying that he resigned due to the fact that the earnings dropped. It's nothing of the sort, and I think he's done an excellent job. He's managed, alongside with his fellow CEOs of different divisions in Billiton, to reduce costs at Billiton significantly.
You wonder where there is for him to go right now. I mean, where do you go from working from the world's largest diversified global miner? But I suppose that question we'll see answered in a few months' time. When it comes to the gold space right now, you're not a buyer of gold stocks?
No, we've never been, and I don't see that we'll be in the near future anyway. The fundamentals of gold companies has always been a bit of an issue for us. When you look at the valuation side of that, the fact that these companies have an extreme cost pressure, especially in South Africa, and South Africa is not the biggest at all player anymore when it comes to gold. We've heard Marco Tifani being very outspoken about the fact that they will look at the assets in South Africa and their assets abroad. And I think that's a very important thing to notice when he's going into Anglo-American, where we've heard a lot of noise made by shareholders about the fact that they're not happy about the South African market environment. And I think that should also be a big wake-up call for all stakeholders when it comes to companies who are managed and are driven for shareholders' value and not for stakeholders' value. And in South Africa, everyone has been very lenient when it comes to that. He did mention the figures, and it is a fact that about 93% of all costs of these gold companies, especially the company like Anglo Ashanti, has actually gone to stakeholders and to payment for employees and all sorts, and cost pressures that's come from here, and only about 7% of that has actually gone to shareholders. Very important to note this.
Yeah, it certainly is the first time. I mean, I've spoken to him a few times. It's certainly the first time he has looked straight into the camera and basically said, jobs, there will be job consequences. And an interesting time in his career to make such a strong statement. He also made strong statements at the mining in Durban, but really illustrating the fact that the mining sector can't be squeezed more. That's what they're saying. And of course, we wait for the outcome of negotiations, for example, at Anglo-American Platinum.
You're right. I think stakeholders in South Africa is very focused on past returns, which is not something that we've been seeing over the last 3 years. And like he also mentioned, in the comparison to the equity market, I mean, it's not been comparable at all. And so there should be a better focus on current returns, the current environment, the very uncertain labour force that we deal with in South Africa, the laws that's not really for the employer but more for the employee, and also all the cost pressures that we've seen from this country. It's not very stimulating for a mining environment.
At the same time, you do need the bare essentials when it comes to living conditions, and you can't be living in an environment where, of course, you're living kind of below the breadline. No,
that's absolutely true. So South Africa will have to move from industry, because mining won't be able to supply that or provide that for stakeholders, which is unfortunately the truth. So South Africa will have to move into other industries if they want to stimulate the employment market, and I think that'll be very difficult for this company.
Well, let's move on to the retail sector right now, because if you're talking about consumers under pressure, perhaps starting to be reflected, or you're talking about jobs under pressure, perhaps starting to be reflected in the retail sales figures. You know, Truworths coming out with their first half earnings, headline earnings per share at 331.3 cents and up 19%. The stock dropped on the back of this news, down almost 1% on the day. How do you rate Truworths?
Well, I think all most of our retail sector is still overvalued, and the big thing is that we now see these earnings coming through, and it's kind of at a tipping point where the investors that's been punting and it's been actually chasing these prices up to where we see them now over the past 3 years, are now kind of waiting and wanting the returns to be in line with the share price growth, which we're not seeing. We're seeing good returns, but good earnings returns, but we're not seeing them being supportive of the strong price movement that we've seen, and that will definitely bring the prices under pressure. The fact in South Africa that we've seen such a strong retail sector and a lot of retail spending is evident in our debt levels. If you look at the debt to disposable income of households in South Africa, it's at very high levels, and nothing that you should be feeling comfortable with, to say the least. We've seen Abel's stance and how they feel about the fact and how they've actually precautioned themselves as a business going forward. So I think there'll be a lot of movement in these areas in the month and year going forward.
I mean, just looking at Truworths, which of course has the credit book, they've got 2.6 million active credit accounts there, and the net bad debt as a percentage of gross bad receivables, debt receivables is up to 9.5%. So overall, you're looking at indicators indicating that the health of the credit active consumers has deteriorated over the period, and that a warning signal.
You're right. This company specifically is very cash generative, so which is a good thing for them, because they're not so reliant. Obviously, they're still reliant on credit for individuals, but they're not so worried about it themselves. The fact that they're still so cash generative helps them. They're not owners of most of the properties that they do business in, like many of the other retailers or the food retailers that we see. So it's still looking relatively healthy for them, but there's a big discrepancy between the price of these companies and the underlying earnings.
Do you hold any of the retailers right now, food or other retailers?
Well, we did buy some Woolworths about 2 years ago when it was trading at a very good price. We've had a return of more than 60% on those stocks, and where it's become a overweight or a higher percentage holding in our portfolios, we definitely did reduce it down. But that's a company that we do like. We think there's a lot of other fundamentals playing a role in that company, and we won't just sell it because we're long-term investors. So we'd rather hold it and play it through the cycles, but the underlying factors of that company is something that we do like.